In a market where volatility has become the norm and unexpected shifts can redefine fortunes overnight, Bitcoin has once again captured the world's attention with a sudden and decisive pump that has left analysts scrambling for explanations and investors recalibrating their strategies. Just days ago, the leading cryptocurrency appeared locked in a cautious consolidation phase amid lingering geopolitical uncertainties, but a swift catalyst has propelled it upward, reclaiming key levels and injecting fresh optimism into the broader digital asset ecosystem. Welcome to Crypto Hub, your premier destination for in-depth, unbiased cryptocurrency news and market analysis. As always, we deliver the facts with the professionalism and seriousness they deserve, cutting through the noise to bring you a clear-eyed view of what is truly unfolding in this rapidly evolving space. Today, we are examining the title that has dominated headlines and trading screens alike: Bitcoin suddenly pumps. What is happening in the market? We will break down the precise triggers behind this surge, contextualize it within the current economic and geopolitical landscape, explore the implications for Bitcoin and the wider crypto sector, and provide a measured outlook on where this momentum might lead, all while emphasizing the disciplined approach required in such dynamic conditions. The surge in Bitcoin's price has been nothing short of remarkable in its speed and conviction, with the asset climbing from recent lows around the $68,000 mark to trade firmly above $71,000 and even testing levels near $72,800 in recent sessions as of April 10, 2026. This represents a gain of approximately 4 to 5% in a matter of days, accompanied by a notable increase in trading volume and a wave of short liquidations that have amplified the move. To understand why this pump feels so abrupt, it is essential to trace it back to a confluence of factors that converged almost simultaneously, transforming what could have been another week of sideways action into a bullish breakout. At the heart of the rally lies the announcement of a 2-week ceasefire between the United States and Iran, a development that has dramatically altered market sentiment by easing fears of prolonged conflict in the Middle East. Oil prices, which had spiked above $112 per barrel amid heightened tensions, plummeted in response to the news, releasing pent-up pressure on global inflation expectations and freeing up capital that had been parked in safe haven assets. This shift has encouraged a rotation back into riskier investments, with Bitcoin emerging as a primary beneficiary due to its established role as a digital store of value and its correlation with broader risk-on environments. Traders and institutions alike have interpreted the ceasefire not merely as a temporary pause, but as a signal that escalation risks are receding, thereby boosting confidence in assets that thrive on stability and growth prospects rather than defensive positioning. Compounding this geopolitical relief has been a significant short squeeze across cryptocurrency derivatives markets, where over $427 million in short positions were liquidated within 48 hours of the ceasefire news breaking. In leveraged trading environments, such forced unwinding creates a self-reinforcing cycle. Falling prices trigger margin calls, which force sellers to cover their positions by buying back Bitcoin, further driving the price higher and catching even more shorts off guard. What distinguishes this particular squeeze is its alignment with genuine spot market demand rather than pure speculative leverage, as evidenced by persistently flat to negative funding rates on major exchanges. This indicates that the rally is underpinned by real accumulation from long-term holders and institutional players rather than fleeting retail hype, lending it a degree of sustainability that previous short-term spikes have often lacked. On-chain data further supports this narrative, revealing increased activity from whale wallets that have been quietly accumulating Bitcoin throughout the recent consolidation, suggesting that sophisticated investors anticipated a positive resolution to the geopolitical overhang and positioned accordingly ahead of the catalyst. A critical pillar sustaining this pump is the continued strength of institutional inflows into spot Bitcoin exchange-traded funds, which have demonstrated remarkable resilience even amid earlier market turbulence. On April 6th alone, these ETFs recorded net inflows of $471 million, marking the 6th largest single-day intake of the year and the strongest since late February. Leading the charge were heavyweights such as BlackRock's iShares Bitcoin Trust, which pulled in substantial portions of the total, alongside contributions from Fidelity and ARK Invest. Cumulatively, U.S. spot Bitcoin ETFs have now surpassed $53 billion in total inflows since their launch in early 2024, a figure that far exceeds initial projections and underscores the deepening integration of Bitcoin into traditional portfolios. This institutional demand is not merely additive. It creates a structural bid for Bitcoin that absorbs selling pressure and limits downside volatility, effectively establishing a higher price floor over time. As these funds continue to attract capital from pension funds, endowments, and registered investment advisors, the supply dynamics shift dramatically. With Bitcoin's post-halving issuance rate already constrained, the combination of ETF accumulation and reduced new supply from miners sets the stage for potential scarcity-driven appreciation, a dynamic that market participants are increasingly pricing in as the rally gains traction. Beyond the immediate triggers, broader macroeconomic tailwinds are playing a supportive role in validating this sudden pump. The sharp decline in oil prices following the ceasefire has recalibrated expectations around Federal Reserve policy, with traders now assigning higher probabilities to interest rate cuts later in the year as inflationary pressures from energy costs ease. Lower real yields and a potentially weakening U.S. dollar index create an environment more favorable to non-yielding assets like Bitcoin, which historically performs well when liquidity conditions improve and opportunity costs for holding cash decline. This interplay between geopolitics and monetary policy is particularly potent in 2026, a year that has already seen Bitcoin navigate a correction from prior highs above $120,000 in late 2025 down to more moderate levels before this recent rebound. The asset's ability to decouple positively from traditional risk assets during the height of Middle East tensions earlier in the quarter, only to accelerate on their resolution, highlights its maturing status as a macro hedge and growth play rolled into one. Analysts have noted that Bitcoin's performance in this environment has outpaced both gold and major equity indices in relative terms, reinforcing its appeal to diversified portfolios seeking asymmetric upside amid uncertainty. Turning to the technical landscape, the pump has manifested in ways that align with classic breakout patterns, familiar to seasoned chartists. Bitcoin has successfully reclaimed the $70,000 psychological barrier and is now challenging resistance near $72,600, with daily closes above this level potentially confirming a shift to a more bullish structure. Moving averages are beginning to align in a manner suggestive of upward momentum, while the relative strength index has moved out of oversold territory without yet reaching overbought extremes, leaving room for further extension if volume sustains. Volume profiles show clustering around recent lows, indicating strong buyer defense in that zone, and order book depth remains robust, with bids stacking up to absorb any profit-taking attempts. For the broader cryptocurrency market, this Bitcoin strength is serving as a rising tide, lifting total market capitalization by tens of billions of dollars in short order and providing a supportive backdrop for select altcoins. Ethereum, Solana, and others have seen sympathetic gains, though the rotation remains measured, with capital primarily flowing into established projects rather than speculative microcaps. This selectivity underscores a maturing market where Bitcoin's dominance acts as a bellwether, signaling overall health before broader participation resumes in earnest. It is worth examining the historical parallels to appreciate the significance of this moment. In previous cycles, similar geopolitical resolutions or macroeconomic pivots have preceded extended rallies as capital reallocates toward high beta assets once immediate risks subside. The 2024 Bitcoin ETF launch year provided the template for institutional-driven demand, and 2026 is building upon that foundation with even greater scale, evidenced by the expansion of products and the entry of additional players, such as Morgan Stanley's recent Bitcoin Trust offering. Sovereign adoption trends, stablecoin growth, and advancements in tokenized real-world assets further complement this environment, creating a multi-layered ecosystem where Bitcoin serves as the anchor. Yet, while the pump is encouraging, a professional analysis demands acknowledgement of countervailing risks. Regulatory developments remain fluid, with ongoing discussions around clarity acts and global frameworks that could either accelerate or temper adoption depending on their final form. Geopolitical ceasefires, by their nature, carry expiration risks, and any resumption of hostilities could reverse sentiment swiftly. Moreover, the Federal Reserve's path remains data-dependent, and persistent core inflation or unexpected labor market strength could delay easing, keeping real yields elevated and pressuring risk assets. Investors must therefore approach this rally with discipline, focusing on position sizing, diversification, and a long-term horizon rather than chasing short-term momentum. Delving deeper into the institutional narrative, the 2026 landscape reveals a crypto market that has transitioned from speculative fervor to a more institutionalized framework. Bitcoin ETFs alone have absorbed billions in the first quarter, with projections suggesting the full-year figure could rival or exceed prior records if inflows maintain their pace. This capital is not fleeting. It represents strategic allocations by entities that conduct rigorous due diligence, stress testing Bitcoin's role in portfolios against inflation, currency debasement, and portfolio volatility. Reports from major financial institutions highlight Bitcoin's correlation benefits and its potential as a digital gold equivalent, with some forecasting prices in the $150,000 to $170,000 range under bullish scenarios by year end. These projections are grounded in supply-demand arithmetic. Annual miner output post-halving is modest compared to ETF absorption rates, creating a persistent imbalance that favors price appreciation over time. Whale accumulation patterns, observable through blockchain analytics, reinforce this view, as large holders continue to distribute minimally while adding to positions during dips, signaling conviction in Bitcoin's long-term trajectory. The altcoin sector, while secondary in this narrative, merits attention as an indicator of market breadth. As Bitcoin pumps, it often paves the way for selective altcoin outperformance, particularly in projects with strong fundamentals such as Layer 1 upgrades, real-world utility enhancements, or DeFi innovations. Ethereum's ongoing developments in scaling and staking yields, for instance, position it to capture spillover interest, while Solana's high-throughput capabilities continue to attract decentralized application builders. However, the current environment favors quality over quantity, with many lower-cap tokens still struggling amid the broader recovery. This dynamic reflects a market that has learned from past excesses, prioritizing sustainable growth drivers over hype-driven narratives. Stablecoin market capitalization, hovering near $315 billion with modest expansion, provides another liquidity gauge, indicating steady but not explosive capital entry that supports gradual rather than parabolic moves. Looking ahead, the question on every serious investor's mind is whether this sudden pump marks the beginning of a sustained uptrend or merely a tactical rebound. Technical indicators suggest potential for continuation if Bitcoin holds above $70,000 and consolidates gains, with analysts eyeing $80,000 as a near-term target should the ceasefire hold and ETF inflows persist. Macro support from easing energy prices and anticipated monetary accommodation adds credence to this view, though vigilance remains essential. On-chain metrics, including active addresses and transaction volumes, are showing early signs of recovery, hinting at renewed network usage that could underpin price action. For those building positions, the emphasis should remain on dollar-cost averaging, thorough research, and risk management, recognizing that cryptocurrency markets reward patience and penalize emotional decision-making. At Crypto Hub, we consistently stress that while opportunities abound, they must be approached with the same analytical rigor applied to any asset class. In synthesizing these developments, it becomes clear that Bitcoin's sudden pump is not an isolated event, but the product of interconnected global forces ranging from Middle East diplomacy to Wall Street allocation decisions. The ceasefire has provided the spark, short squeezes the acceleration, ETF inflows the foundation, and macro shifts the tailwind, creating a moment of genuine momentum in a year defined by prior corrections and cautious navigation. The broader market is responding in kind, with total capitalization expanding and sentiment metrics lifting from extreme fear levels that had persisted for weeks. Yet, professionalism dictates balance. This rally, while compelling, operates within a volatile asset class where reversals can materialize quickly if catalysts fade. Investors would do well to monitor key levels, upcoming economic data releases, and any evolution in the ceasefire agreement, using these as guideposts for informed adjustments rather than reactive trading. As we conclude this comprehensive update on the cryptocurrency landscape, it is evident that Bitcoin's resurgence serves as a powerful reminder of the sector's resilience and its capacity to adapt to shifting global conditions. The events of recent days underscore the importance of staying informed, remaining objective, and viewing market movements through a lens of long-term structural trends rather than fleeting headlines. At Crypto Hub, our commitment is to equip you with the insights necessary to navigate these waters confidently and responsibly. Thank you for joining us today as we unpack the reasons behind Bitcoin's sudden pump and what it signals for the market at large. We encourage you to subscribe, engage with our community, and return for our next professional analysis. Until then, stay vigilant, invest wisely, and remember that in the world of digital assets, knowledge remains the most valuable currency. This has been Crypto Hub, delivering the serious market intelligence you deserve.